this video, we're going to talk about Disney's Q1 earnings. Today's February 12th. They reported last night. I should have made the video last night now that I think about it, but I already had a different video planned. So today we're going to go through this and we're going to check out, just the earnings and I guess form some opinion on it. I guess none of this is really financial advice. We're just going to be diving through their financial statements. I'm not like some super smart wizard or anything. I'm just going to talk about my opinions about it. So let's first view the shorter document. This is the just financials, I think. And then we can break it down a little bit farther. I guess we don't even really need to see this because it should just be in this. Let's get through. Oh, it's literally like one page. I guess like three, but yeah, we'll quickly go through this. Alright, so blah blah, free cash flow. Actually, wait, yeah, these are all non-GAAP measurements, but let's see. So December 28th, 2019. So it's basically a year, 1 year and a quarter, right? Yeah, a year and a quarter. Cash provided by operations, so they got like nothing. Very big change. They were able to get investments in parks and resorts and properties. That was a lot more. The free cash flow's down a lot. Let's see what the numbers. Yeah, I don't really care about these numbers. Operating income. Alright, let's go, baby. Total operating income. So, still doing a lot worse. This was still before, right, the pandemic. So, just gotta keep that in mind. These are completely different numbers, or different time periods. But yeah, the operating income's down 67%. Total operating. All right, let's go to the other document. This will be a lot better. All right. Walt Disney Company today reported earnings for its first fiscal quarter ended January 2nd, 2021. Diluted earnings EPS. Diluted earnings per share EPS from continuous operations for the quarter decreased 98%. Wow. From the prior year quarter, excluding certain items. Okay. Diluted EPS for the quarter decreased 79%. The most significant impact was Disney Parks. Yeah, we know that. Our parks have been closed. Operating capacity and our cruise ship sailing have been suspended. Yep. Okay, wait. This is who's this coming from? Bob Chapek, the new CEO. With Bob Iger is no longer. I think we have Bob Iger. Bob Chapek's the new dude. We believe the strategic actions we're taking to transform our company will fuel our growth and enhance shareholder value, as demonstrated by the incredible strides we've made in our DTC business, direct-to-consumer business, reaching more than 1.4 million total paid subscriptions across our streaming services at the end of the quarter. Wow, that's a lot. Said Bob Chapek, we're confident that with our robust pipeline and exceptional high-quality content and upcoming launch of a new Star Wars branded international general entertainment offering, we're well positioned to achieve even greater success moving forward. This is the thing, like again, their streaming service I think has so much potential. As long as they don't mess up, like Star Wars, Marvel, and all the other brands they have, because they can just put that direct to consumer. So many people want to view the content. They're going to be willing to, pay for the subscription. I think, if they seriously put the main thing I'm looking at from this earnings call is not how much money they're losing from their parks and everything, but how much money they're generating from the Disney Plus, basically, and how fast are they growing. And I need to somehow put a price on that. Disney's down 1.4% right now. It's at $188. I don't want to buy more at that price, but man, I don't know if we'll get another opportunity for lower. Alright, let's look at the revenue. Revenue decreased 22%. Income from continuous operation 98%. So, I mean, basically everything's down. Their EPS is non-existing. The way I like to think of Netflix or Disney is it's just Netflix, but it has amusement parks as a bonus. But right now it's not a bonus. It's a liability, I guess. Let's see. Net income. Basically, not earning anything, so. Yeah, I don't need to see that too much. Segment results are the company values the performance of the operation. Yeah, we know. Different segments, okay. Total segment. Which segment is this, though? Alright, since late in the second quarter of the fiscal year, continue COVID and measures to prevent spread. Alright, yeah, we know that. Initially, we've delayed, in some cases, shortened and canceled theoretical releases. Yeah, there's no stage performances going on. We've experienced disruptions, reduction, availability of content, including the cancellation of shift the key live performances. Yeah, they can't really having difficulty filming new things. Although most film and television production resumed beginning the fourth quarter of fiscal 2020. We continue to see disruption of film and television product depending on local circumstances. Yep. The timing, duration, and extent of the cost will depend on the timing and scope of our operation as they resume. Right here, they estimate these costs may total $1 billion in 2021. So, I mean, that's what they're estimating. But it could be more, you know. The most significant impact on operating income was from COVID. It was estimated $2.6 billion at the Disney parks and resorts due to. Yeah, I mean, nothing we don't really already know, right? Let's see some numbers. Revenue, Disney Media. I mean, it's actually not down a lot. Disney Parks and Experiences, that should be down a lot. Total Disney segment operating income. I'm more interested in the operating income because, I mean, it's, you know, revenue is one thing, but it's like how much money you're making from the revenue, so. Yeah, I mean, that's actually interesting. It's not Disney Media Entertainment Distribution is not down that much. Is that including Disney Plus? I'm not sure. Let's see further. Disney Media Entertainment revenue and operating results for Disney Media and Entertainment Distribution segments are linear network was up 2%, direct to consumer up 73%, constant sales and licensing down 56%. What is this? Elimination. Oh yeah, eliminations. Operating income. Like their direct consumer actually operating income. They're losing money. I guess right now because they're still. What do you call it? The amount of money it costs to create the content in the platform costs more than how much money they're making. But it's like, so we can take a look at like how many subscribers they have here this day, and then this, and then see, you know, where the amount of subscribers they would need for Disney Plus to, you know, have a very positive cash flow. The decrease at cable was tied to programming costs and lower advertising revenue, partially offset by affiliate growth. College playoff football, NBA programs. Okay, yeah, so international channels. I always forget they have this stuff. Indian Premier League cricket matches. That's a cool sport, cricket. Never really watched it, but maybe one time. Direct-to-consumer revenues for the quarter increased. The increase at Hulu was due to subscriber growth and increased advertising revenue driven by higher impressions, partially offset by an increase in programming production costs due to higher subscriber-based fees for programming. So I guess they raised Hulu's price. The improvement in Disney Plus driven by an increase in subscriber, partially offset by programming and production cost. Increased marketing and technology costs. The increase in subscribers and costs reflected the ongoing expansion Disney Plus, including launching in additional markets. Higher results of ESPN Plus were driven by subscriber growth, or higher, partially offset by higher sport programming. Okay, so wow, they double 3 times maybe the amount of subscribers of Disney Plus. This is paid subscribers in millions. ESPN basically doubled. So I mean, pretty good. Let's see number 3. What is number 3? Disney Plus Hotstar launched on April 3rd, 2020 and September 5th. In India and Indonesia. Yeah, Disney Plus Hotstar is significantly lower than the average monthly revenue paid in other markets. consumer business, at our consumer products business. Our income is driven by increasing games license revenue like the Marvel Spider-Man Miles Morales. Estimated total net adverse impact of COVID is approximately, yeah, we know that. Here's some numbers breaking it down. Down 70, down 60. Yeah, consumer products. I was anticipating this to be about the same, you know. I thought it'd be kind of higher just because I feel like more people would be buying stuff. I don't know, but yeah, getting kind of pooped on over here. Yeah, restructuring stuff. I'm just gonna kind of skip this. I mean, it's important, but let's see the cash flow. Cash flow's down a lot of money. Obviously, I mean, again, like, you know, when you look at the numbers, Disney's not in like a hot spot. I think, yeah, we'll talk about that in a second. Capital expenditures and depreciation expense. Yeah, I'm not gonna look at this. These are all non-GAAP measurements. Free cash flow. I mean, if you look at the numbers, yeah, free cash flow is up, I guess, but cash, that's literally, they just have more cash on hand, because then they got like a bunch of loans, I think. So, I mean, that's how the numbers are kind of manipulated, right? Dilute EPS, alright, skip this stuff. Do they have their balance sheet and stuff? Forward-looking statement. Yeah, so this is all like kind of speculation, but it's kind of important to see how they expect the company to do in the future. So, oh, here we go. Alright. It's kind of interesting how they're. Is this a quarter ended, or are they? I guess they're just comparing it to. Yeah, I think. They don't mention it here. Maybe they do, but. Right, like, shouldn't they be comparing it to. Actually, yeah, December 28th, it's basically the same quarter, my bad. I kind of, for a second, I thought, like, this is basically January 1st, you know, it's the same quarter, not a month and a half, like I mentioned before. Oh, people are probably gonna rip on me for that. I mean, revenue's actually not doing too bad, to be honest. But it's how much money they're making from the revenue. Net income's down a lot. Where's income? Or operating income? Do I not see it? Operating income. I mean, I guess we did look at it before, so net income from continuous operations is down a lot. So I mean, yeah, the revenue might be not as bad, down 4 billion, I think. But man, that's down a lot of billions. Like no EPS. Not good for shareholders. But you know, it's about future expectations, current assets. Looking kind of fine. I guess goodwill. I don't like how they always have so much goodwill. There's the property. It honestly looks exactly the same. Yeah. I know. So last quarter, 2 quarters ago, Disney had some stake in like DraftKings. I think they sold it though. I think like last quarter or something, they had some stake in DraftKings. I just tried to find it, but it made a loud sound, so took that out. Yeah, I guess. I mean, the numbers look exactly the same. I mean, actually, where's the debt? It should be down here. I know. Current liabilities, 26, 34. Oops, past it. I mean, like, I'm not an expert, but this seems kind of fine. But I feel like it shouldn't be fine. Because I remember, like, they had to take on a lot more debt to support this. Or just support the company. Let's check out, what is this? Cash flow. Let's see where the money's going. I mean, their cash flow is definitely going to be negative. Or should be like a negative balance. guess financial. Yeah. Borrowing. Net. So that means they paid back stuff. Is that how that works, right? Reductions from borrowing. Investments. So they actually start selling some property. Both quarters. Again, I'd have to look like really much deeper. Probably go to the SEC website to look at specifically, what did they sell, what they buy. But I don't know if I care too much about the cash provided for continuing. Yeah. Okay. I mean, here's the thing, like, let's see the Tiffany news. That's really it. Right now they're down 1.4%. Here's the thing, like, they don't look that bad, but like, they're gonna suffer for a bunch more quarters. And it's like, do I want to put in more money on the hopes that other people try to bid up the company, in the hopes of a reopening, and their Disney Plus platform gets more subscribers, and they could get to that like peak number where they can start generating a lot of operating income based on those subscribers. I think they'll get there, but it's just a matter of when, and do I want to take on the risk now? And that I don't know. Their estimated EPS was negative 0.448, but they actually got a 0.02, which I mean is still kind of bad, but it's, I don't know. I have a lot of faith in the company. Wait, wow, that's crazy. 2000. So cheap. Yeah, I have faith in the Disney Plus platform, a lot of it. I don't want to put too much faith in it. Like right now, I'm at a good price. I definitely don't have the amount of shares I wanted. I've heard if the parks like reopen, I don't know. I think this COVID stuff is gonna be around for quite some time. Just not in like a pessimistic way. I just think the government's gonna try to manipulate it, as far as they can. And I think the parks are gonna suffer. Was basically what I'm saying. The Disney Plus or Disney's parks are gonna suffer, but I mean they got the products, they got the loyal fan base that are dying to go back. Once it does actually reopen, I think the Disney Plus platform will continually grow rapidly. It's just they have to make the content and spend a lot of money on it to get those subscribers. And let me see some Netflix. Do I even have Netflix on my watch list? I don't think I want to buy at this price though for Disney. Maybe 175. 170 is like around here, but it just seems extended. But again, it could just take off because the vibe. And I guess I'll just wrap up. I know I kind of looped around this conversation like a bunch, but it's like a hard conversation because it's like, dude, when do you decide to pull the trigger and add more shares? I think I might just add like one share every week. Like it doesn't matter what day, just buy one share. Just buy one share every week. I'll see what happens, but I do like this company a lot. I think the parks are gonna stay closed for a while, or they're gonna have limited capacity, so they're gonna lose a lot of money. I think they'll be continually hurt with, trying to make the content and stuff for Disney Plus. But I think we'll continually see subscriber growth and revenue growth, or operating income, based on more subscribers. But they have to continually make new content, like The Mandalorian, but other stuff like they need multiple banger shows, and to keep the people happy. But I think that's where the money's at. But they're gonna continually suffer until this opens back up, I guess. Yeah, I think that's the best way to put it. Definitely need to buy more shares, but I don't want to be, yeah. Let me know what you guys think though. It helps when I hear other people's opinions. Because again, like, this is the company I would buy if you told me that there was no cost. Like, I just want to own a percentage of the company. But like, if I know, or not if I know, but if I have a good hindsight or foresight that they're probably not gonna be making money for like another quarter or two, like, there's probably another good buying opportunity. But I don't know if, taking that risk, is something that I should do, or just gonna keep shooting higher. Alright, anyway, I'm kind of just rambling now, but thanks for watching. I love Disney, love the company. I mean, there's some aspects of the company I don't like the political side, I guess, but for the most part, it's a pretty good company. I like the products they have and the entertainment, so, yeah. For right now, the stock, I gotta keep thinking about it. But maybe that's what I just gotta do, is not think and just buy consistently dollar cost average, so. Anyway, thanks for watching. Let me know what you guys think.